This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So this week, I'm not running any screens. I'm just going off of my own knowledge about a bunch of beaten down stocks. We all have a list, right, that we keep, stocks we're watching. Some of these have continued to decline year over year. And now a lot of them are at 5-year lows. So I am kind of curious on some of these names. Is this a time to buy once you get down at those 5-year lows? But always have to keep in mind that a 5-year low can turn into a 6-year low. So maybe it's not the time to buy. Maybe something else is going on at these companies, and that's why the stock looks so terrible. But we always like to look around for bargains here on the Value Investor Podcast. And we like to dive in when everybody else is still running away, because that's what value investors do. But remember, just because it is at those 5-year lows doesn't mean it's a true value. It could be the trap. And remember, the trap is defined as basically falling earnings. It's having falling earnings perhaps this year or, 2025 it had it. It's expected to continue decline here in 2026, maybe possibly even into 2027. If that's the case, it's probably a trap and we don't want to be in it. Because we want companies that are growing their earnings. There's over 4,000 stocks covered by the Zacks rank. That's a lot of stocks. And we shouldn't really waste our time on companies that are struggling, because there's a lot that aren't. And we can find cheap stocks that have some good growth and that are growing those earnings. Some of these may be a little more cyclical. Some are coming out of a boom during the pandemic, and now they're kind of paying the price for that as customers, the consumer has moved on to other parts and things to do. And so they're no longer spending on the items that were in demand during the pandemic. But we are a couple of years out of the reopen now of the pandemic. And so we should be seeing some stabilization in some of those pandemic type of stocks. But are we? I don't know. We're going to dive in on 5 of them this week, because I couldn't just really keep it at 3, because I do have a pretty long list of these stocks. And I am curious to see, are any of these deals or are they still traps? Okay, let's start off with Whirlpool, ticker WHR. They make the appliances. So when housing was booming at the start of the pandemic until the Fed raised rates in 2022, Whirlpool was booming too. It couldn't make enough refrigerators. Remember when you had to wait 6 months to get a refrigerator? That was actually happening. Now, not as many homes being built, not as many people moving. They're just not buying those appliances. They're not doing the kitchen remodels. We know that from Home Depot. And then top it off, you've got tariffs coming on, tariffs on things that go into making the appliances like steel and aluminum, and just a whole host of issues going on with a company like Whirlpool. But they've been around a long time. They've managed to survive. And so let's take a look and see what's going on. So the stock is trading near the 5-year low. It's gotten a little bit of boost here in 2026, but it's still way down there. Forward PE is at 11.8. So that is cheap right now. They do pay a dividend, and they've been holding firm on the dividend, and it's $3.60. The yield on that is 4.3%. So the stock has fallen so dramatically now that, the yield is pretty high. That's always a sign too that it's a little bit in distress. Price to book is 1.8. That is in the value range. We look for 3 and under. Price to sales is 0.3. We look for 1 and under for true value. So this is dirt cheap on the price to sales. Price to cash flow is low too, 3.3. So all the basic fundamentals look, pretty cheap here and would meet the classic fundamentals of a value stock. But let's take a look at earnings. We know it's been on the decline for all the reasons I just stated. So last year, 2024, they made $12.21, expected to make just $6.68 this year, 25. So we're still waiting on the report for 25. And that's a decline of 45%. So we know it's been bad. They're actually, as I'm recording this, they're about to report earnings. So by the time you listen to this, they will have reported. So we're going to see, is 2026 looking any better? Right now, going into the number, we do have $7.11, a gain of 6.3% for 26. And one estimate is higher going into this report. So some of the analysts are thinking, okay, maybe the bottom is in on the earnings side and it's going to get better from here. So we'll see. This doesn't look like a real trap right here if these earnings hold, but we're waiting for this earnings report and we're going to get some outlook here for 26. We already kind of know that the home builders are still pretty much struggling. We were all kind of waiting for President Trump's plan to help housing. He's supposed to announce it at Davos, but there wasn't much announced there. So we're still waiting on some kind of maybe government help to spur new home buying or even existing home buying as well. You still need to buy some new appliances sometimes, even if you buy that older home, especially if you buy the older home. So let's see what develops here. But this isn't looking like a big trap here, and they can afford to pay out this dividend with these earnings. So they're not in the negative on the dividend. So let's see. Maybe this is why it's getting a little boost here in 2026 off of those lows. Lows were around $65, and it's trading right around $85 right now, going into this number. So that's Whirlpool, WHR, maybe a deal here and not a trap. Okay, the next one I want to look at is Estee Lauder, ticker EL. I don't think we've ever mentioned this one on the Value Investor podcast because Estee Lauder soared during the pandemic. It soared for years, and it was one of the big beauty plays, and it ended up trading for like 80 times on the PE level. And so there's just no way it was in the value range, but it too has staged a huge sell-off. It was at 5-year lows in 2025. It has more than doubled off of those lows now, as maybe things aren't quite as bad as everybody thought. And it was really getting hammered in China as the consumer there really pulled back. But it looks like the Chinese consumer is starting to come out of their funk from the last couple of years, and that would be good for Estee Lauder. So Estee Lauder, again, ticker EL, is market cap of $41 billion. Dividend is $1.40, which is yielding 1.2%. But forward PE, I haven't looked at this in a while. Forward PE is still pretty stretched, up there at 53 times. But the PEG ratio, not so much at 1.4. It had declining earnings in 2023, 2024, and 2025. 2025 down another 41%. So it's just been down, down, down. And that's why the stock was down, down, down. But 2026 earnings estimates expected to be up 43%, but that's after, crashing down. So we are getting the bounce, or we hope to, and then 27, another 36%. So that's why we've seen a doubling in the stock. People thought maybe it just went too far and things are looking up finally. And so they're back in it. But I wouldn't really call this one super cheap. It's not a trap here, though. if these numbers hold. It's about to report earnings. It hasn't reported yet. We have a price to book, though, on this one of 10.8. That is not cheap. Price to sales is 2.9. That's not cheap either. So none of the traditional value metrics are telling us that this is a cheap stock, but it looks like it's coming out of the trappiness. But maybe we missed the bottom, so it's not a deal here either. So not a trap, but not a deal for value investors. Could be a deal for growth investors, however, if this growth trajectory does hold. I know many growth investors are not, worried about paying 53 times, especially if you got that peg a little lower. So those earnings are growing. It's not as extreme. But for traditional value investors, you might want to wait and see on this next earnings report to see if all this is holding here. But that's Estee Lauder, ticker EL. Okay, we're going to switch to another beast from the growth era and from the pandemic, which is Deckers Outdoor, ticker DECK. One of the favorite ones I've watched for several years. It peaked in early 2025 before the stock started its big sell-off. A lot of that was from the tariff issues and heading into Liberation Day. But it did make another bottom late in 2025. Now, Deckers Outdoor, I always did get it confused in the beginning because it's got that outdoor in there. And I'm like, is this some kind of, camping company? But it's not. It's shoes and accessories. They do some apparel now as well. They do UGG. That's their main brand. But also Hoka, just been exploding the last couple of years. But now, maybe not so much. Now, they did not go into the red on earnings. So 2025 earnings were still up 30.2%. But now in 2026, and we are also going to get the report this week. So by the time you listen to this, we'll have had their earnings. So this is the holiday quarter. That's key. So it's key to tune into this earnings report. But 2026 earnings are expected to be up 1.1%. But after year over year of double digits and, 50% gains in 2024 on earnings, to see it at 1.1 is not great. And then next year, which is their fiscal 2027, we're looking at 7.5%. So a little bit of a rebound, but still not the level they were doing. So is the growth story really over with Deckers? The big growth story, or is it cheap enough now for value investors to get in, or is it in that middle area where neither one really likes it? So forward PE on Deckers is 15.7. So that's right around where I look for value, and that is cheaper than I've seen this stock in quite some time. Some of its other metrics are not that cheap, though. Price to book is at 5.9. That's pretty stretched. Price to sales is 2.78. So 2.8. That's not cheap either. So PEG ratio 4.5. That's not that cheap because the earnings aren't really standing out here. The shares have, again, really come down, but it's not really looking like a deal here yet still. I still would like to get it a little bit cheaper. But on the trap side, if these earnings for 2027, this rebound of 7.5% holds, it's not a trap here either. It's just not cheap enough for value investors and not great enough growth for growth investors. So you're kind of in this no man's land. But we'll see if they fix that, if they give guidance that sounds a little bit better, if the consumer is back out there spending, if they're able to control the costs on those tariffs and, stay on trends with their product. We'll see. But that's Deckers Outdoor, ticker DECK. Okay, another big winner during the pandemic, but it too has really sold off, is Pool Corp, ticker POOL. I think we've looked at this one in the past because it kept going down, down. And I think I complained like, oh, it really hasn't collapsed enough. It was still too expensive, even though earnings were on the decline. And people hadn't thrown in the towel on Pool Corp completely. But let's look at it now. So it did trade at a new 5-year low going into 2026. It has bounced off of it. So some bottom feeders did come in to buy it on those lows. It used to trade around 30 times on the PE, the forward PE, and now it's trading at 22.8 times. So it is cheaper on a PE basis now than I've seen it in a while. But those earnings still continue to decline. So they were down 27.6% in 2023, 17.1% in 2024 as people stopped buying pools and the economy reopened and they could go on vacation and not buy their own pool anymore. And then 2025 down 1.8% still. And they're still going to report the final quarter, so we'll find out if it really did end up in the negative. But then 2026, the estimate is showing 6.5% gains. So finally, maybe things have bottomed, and the consumer's going to start buying pools again. Some of the reasons for the pullback in the earnings was not just pool forward, which a lot of people did. They bought the pools during the shutdown, but also that the cost to build the pool has risen with the cost of the interest rates rising. So a lot of loans have gone up, and so it's more expensive now to put in the pool. And then I'm not sure what the tariffs have done, because in addition to the pools, they sell a lot of the items that go into the pools, a lot of outdoor furniture and things like that, and not sure what is happening on the tariff side with that type of product either. So there's a lot going on with Pool Corp. But is this a trap? Well, it might not be if earnings are expected to rebound in 2026 by that 6.5%. But the PE is not super cheap here. And so I'm still kind of in the camp of where I was before. Although it has fallen further, people have finally thrown in the towel. Price to book is 7.1. That's not that cheap. Price to sales, still a little elevated at 1.9. Not as bad as some of the others. Not a classic value, but, not dirt cheap on the price to sales. PEG is at 4.6. That's not cheap either. So this is another one where it might not be a trap, but it's not really a growth stock yet. And it's still not quite cheap enough for me to be that value, that at least deep value. I've been patient for a couple of years with Pool Corp, so I'm willing to be patient a little bit more to see if maybe some more people throw in the towel and I get it a little bit cheaper yet still. So that's Pool Corp, ticker POOL. And then I wanted to finish with the stock that just keeps making new lows. This is a classic example when people say to me, well, Tracey, how much lower can this go after it hits a 5-year low? Because Helen of Troy, ticker HELE, has continued to make new lows even into 2026 now. And it's fallen since the start of 2022 with seemingly no end in sight and people really throwing in the towel. So they had negative earnings in 2023, down 23.5%. Negative in 2024, down 5.7%. Negative in 2025, down 19.5%. And now they're in fiscal 2026, exposed to be down another 50. Some of this is because of the tariffs. They did make a lot of product in China. They have been moving most of their manufacturing out of China, but not all. And then, unfortunately, some of the countries they've moved it to also have tariffs, not as high as China's tariffs, but still some tariffs nevertheless. So it's just been very much a struggle, and then a struggle on passing along some of these tariffs to the customers. And are the customers willing to pay it? 2027, we have earnings just flat, zero. So after this bad year, they're not really seeing any gain for fiscal 2027. It's still a ways off, so we'll see, but they're just very pessimistic. It is also a Zacks number 5 strong sell, because those estimates were cut off of the last earnings report, which came a couple of weeks ago. And nobody revised their earnings estimate higher. They all revised lower. They don't pay a dividend. Market cap now is just 406 million as it keeps falling. This is the type of company that until it finds its footing, I really don't want to be in it. It does have some outstanding brands. It does a lot of smaller hair appliances like curling irons, hair dryers, things like that. It owns Dry Bar, a great brand. It owns Vicks, so it does a lot of air machines, humidifiers. Sorry, I was having a brain freeze there. Humidifiers. It does the OXO brand in your kitchen. So I really recommend the one that cuts the avocados, by the way. It's green and it takes out the nut in there, but you will never end up in the ER cutting your hand if you use that OXO avocado cutter. Just a plug there for the OXO avocado cutter. But enough of us are not buying these things yet. And so the analysts are still cutting. Like I said, one is even cut in the last week now I see, and earnings were a couple of weeks ago. And that's where we got 4 cuts for this fiscal year and 4 for next fiscal year. So this year's earnings went down to 341 from 410. So that's pretty considerable cut again after it's been cut for the last couple of years. So things are not good at Helen of Troy. This is a trap right now. Even with a PE of, are you ready? 5.2. PE of 5.2. But sometimes when you get a PE that low, you do have to really dig in there and see what else is going on, because really most companies shouldn't trade at 5 times. Price to book is just 0.48. Price to sales 0.2, price to cash flow 2. These are all dirt cheap, but until those earnings turn around, until we see some kind of bottom, then this is a trap in my opinion. And I'm not going to get in there because it could still fall further, especially if they can't turn it around in the next quarter or 2. So Helen of Troy is on the trap side here this week on the Value Investor, ticker HELE. So we have one trap, and all the other ones are not traps, but 3 out of the 4 are not deals either. Whirlpool is the only one that's not a trap that looks like a deal here, but it's about to report earnings, so we will see. And on some of these, they definitely are still going to be reporting earnings, not Helen of Troy. We've got to wait until April to hear from them again on earnings. But they may be at some conferences and whatnot, so keep an eye out for that if they do give any other kind of guidance or insight into what's going on. But Whirlpool, it turns out, is the only deal out of these 5 beaten down stocks. This is why it's hard with these beaten down stocks, because something is going on when they're going to the 5-year lows. And when you see some of these where the earnings are just on a decline year after year after year, and we want rising earnings estimates like we may be seeing at Deckers, perhaps, and Estee Lauder turning it around now, and Whirlpool perhaps turning it around. And then we don't know for sure on Pool, maybe this year they finally hit the bottom. We'll see on Pool. And then Helen of Troy not turning around yet. So it is difficult to try to find hidden gems just based on the chart. That's why we have to go in and look at what's happening with the earnings. And the Zacks rank really does tell it all on Helen of Troy at the number 5. So it's telling you those analysts are seeing bad things going on there with the earnings. Whirlpool, on the other hand, is a Zacks number 2 right now, heading into the number. So the analysts more bullish on Whirlpool right here. So let's recap those stocks again. So we had Whirlpool, WHR is the ticker, Estee Lauder, EL, Deckers Outdoor, D as in David, E as in Edward, C as in Charles, K, DECK, Deck. Pool Corp, P as in Paul, OO, L as in Larry, Pool. And then Helen of Troy is H as in Harry, E as in Edward, L, E as in Edward. So as always, you want to be sure to subscribe to get all of the Value Investor podcasts. There's a lot going on in value right now, and we're going to be covering it all as this earnings season rolls on. We're going to be able to get some of those Zacks number 1 ranked value stocks going, and I'm going to be covering some of those. So be sure to subscribe. Get us on Apple. Get us on Spotify. We're on Amazon Music. And, of course, we have our own YouTube channel with the podcasts. We are on Zach's podcast channel on YouTube. It's audio only, but be sure to subscribe over there because you'll also get the ETF Spotlight and a couple other podcasts also on our podcast channel. So subscribe and get notified when the new one drops. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.